What's up, guys? We need to talk about something today, and that is interest rates and where they're headed. And I want to explain a few things that will kind of give you a general knowledge as far as history, because history always repeats itself. And I want to tell you where they're going and how there's been a fundamental change that will change real estate, finance, anything with an interest rate forever. Okay, so the first thing that I want to note here is that this is a chart. Now, you do not have to understand charting or finance or anything to understand what I'm about to explain. So, with that being said, this is the 10-year treasury. What the 10-year treasury is it is a note that the federal government issues with a guaranteed return with interest to investors to pay out in a decade or 10 years. Now, the reason that I follow this is because mortgage rates almost directly follow the 10-year treasury. And so for me, it's the easiest thing to track as far as where mortgage rates are going. And typically there's about a 2.5 to 3% spread on the 10-year treasury and mortgage rates. So for example, right now, you're about 4.5 on the 10-year and you're at about 7.25 to 7.5 in mortgage rates. So it's about a 3% spread right now. Now, what I want to show you and what I want to explain in layman's terms for people that do not understand charting is that everything that has a chart or in the markets is chartable. Okay, and everything trades in trends. Everything follows trends and patterns. Okay, and history always repeats itself. So the first thing I want to show you is this 10-year treasury goes back. It's going to kind of show you where interest rates have gone and where they're going. Okay, you can ignore all the notes. I'll go through those here in just a minute. However, first thing I want to note is that this chart actually starts like right back over here in 1913. Okay, so each one of these candles represents 1 week. So I want to give you the whole thing to kind of give you a picture of what all is going on here. Okay, so in 1913, you'll see everything trades in an upward channel or a downward channel, or it can sometimes trade side to side. Okay, which means just like trades in a range until it breaks out one way or the other. Now you can see from 1913 all the way up until 1984, we actually were in an uptrend. These are very violent swings. Obviously, you have the Great Depression, and then the inflation of the 70s is in there as well. You can see that if you look in here in the 1970s, you can see what happened to this, which also happened with mortgage rates during that time. And it looks very similar to where kind of what we're going through right now, but that was obviously a large scale. Anyways, this thing traded in an uptrend until 1984. Okay. So for 70 some odd years, it traded in this upward channel without any downward movement. Now, where people get, confused is you have these big drops right here, right? Like, look at this big drop. This doesn't necessarily mean that you're now headed down. This always just means that you're touching the top and the bottom of the range. So 1984 is when the downward channel of interest rates started. And you can see it always just like a ping pong ball, just bounces up and down and up and down and up and down in this channel. And anybody that's been in the real estate markets or the financial markets for, anybody that was born or that's been in the business prior to 1984 has never experienced an uptrend in the markets. Like, you're going to find very few people that actually experience this in the business world. They're simply too old. So we're in a fundamentally different place than we have been previously. Okay. Now, ever since 1984 up until 2022, we have been in a downward trend, a downward channel of interest rates. So everybody thinks, oh, interest rates have to come down. It's only because that's always happened in their lifetime. Okay. Because their whole lives from 1984 to whenever, every time they go up a little, they always come back down. They always come back down, but it's because they are trading in this channel. Okay. So we've never experienced, for the most part, that, we've never experienced a higher interest rate environment, right? So this was all fine. And this was pre '08 here, and this is after '08. Even then, during that recession, but you didn't see a bunch of wild violent swings like you did here, but still in a downward channel, even after '08, even when, rates recovered, they're still trading in this channel up and down, up and down, up and down until February of 2022. And I actually amplified the chart right here so you can see it just a little bit better. But in February 2022, we finally broke that chart. Now, anytime in the stock market, they always say that range bound is the rule and a breakout is the exception. Okay. So you can see that anytime it touches the top or the bottom of this channel, obviously it does have a chance to break out of that and start a new trend. But the rule is typically, as you can see, the rule is usually range bound. So we usually touch the top, touch the bottom, touch the top, touch the bottom, get close to the top, get close to the bottom, and it just stays in these channels. Okay. Well, in February of 2022, this fundamentally changed forever. Something we've never experienced. And that's why you see a lot of people that are out giving advice that don't really understand what's going on because they've never experienced anything like this. Okay. You can see we broke that and we now started an upward channel. Does this look familiar? It looks fairly familiar. And you can see that these can last, like this one lasted 70 years. This one lasted 40 years. Okay. And another thing that I want, let's, before I go to the next part, I want to show you this. So this upward trend that we've now established, here it is right here. So you can see we keep touching the bottom and the top and the bottom and the top and the bottom and the top. Okay. Now here about 2 weeks ago, this is April of 2024. Here about, I don't want to say probably a month or two ago, we got in the low to mid sixes in mortgage interest rates. And that was this. See all these red candles, these represent a week. So, we had 7 or 8 weeks in a row where rates were coming down and everybody thought we were hitting a refinance boom. I kept telling everyone that, no, we're probably just touching the bottom of this channel and going up. And sure enough, we did. And so we have now started an uptrend. So before I go to the next part, the first thing I want to say is that until a black swan type event happens, interest rates are headed higher for longer, okay? Or will at least stay higher for longer, right? We are now in an upward channel, and until something breaks that, it's not going to change. So all these people saying, that date the house or date the rate, marry the house, date the rate, whatever it is, it's fundamentally wrong, and it's because they don't understand the financial markets as a whole. And again, I'm going back to 1913. This is pretty clear. You can see what happens. It always honors these ranges until it breaks out, right? So in February 2022, sorry, my stupid dog. In February 2022, we broke out of that, started this channel. Now, what does this mean? And how do we need to be educating people? And what do you need to know if you're a consumer watching this? The first thing you need to know is that anybody that cannot look at this and tell you what's going on, never take money advice from them, okay? Anybody that knows anything about the financial markets or anything about finance can at least look at a chart and tell you what's going on, okay? So anybody that can't do this or that doesn't show you these things, like if you're going to buy a house or anything like that, or even if you have a financial advisor that can't read charts, God forbid you have a financial advisor that can't read charts. Get the hell away. Take zero financial money advice from them whatsoever, okay? So what this means for you is that you're going to have to block the noise out, because what is happening is it's somewhat of a panic, because nobody in our lifetime's ever seen an upward trend in interest rates, right? It's always touched the top and went back down and touched the top and went back down. It's always been headed down for most people's lifetime, but not anymore, okay? So with that, we're in a different environment. We're in an environment that looks more like this. So what that means for you is our whole generation money has been cheap. Meaning, like there were people running around, and I was partly guilty of this until I really learned this part. I didn't do it for very long, but back in the 2020 days when, interest rates were 2%, I was telling people, oh, you got to cash out your house and put the money in the market because you're going to get better return. Well, things don't always stay that way, okay? You're in upward trends or you're in downward trends. And so what I learned through that is, Dave Ramsey, I used to hate on him and shit on him all the time. He looks a lot smarter to me now because he gets the broad picture like this, right? Because if you weren't in the business pre-08, as you'll see from this note here, you don't know what high interest debt looks like. You're used to debt that's free money, okay? Used to really low interest debt. We are now no longer in this environment, and so things change. And the reason I say Dave Ramsey looks a lot smarter now is because his ideals and principles are more cash, less debt, and you can't get rich financing things and over leveraging things. And I've had a lot of realtor partners and even myself in some capacity in the very, very beginning, 4 or 5 years ago before I learned this, I would tell people that, oh, you should just finance all of it. I'd only put 5% down on my house, or, just because rates are so cheap, money's so cheap, you can get 10% in the market. But at that point in time, my realtors and myself were missing the point. It's because anything that you do is for a long period of time. Like you hear the saying, long term wealth through real estate. Okay. This little blip of 2017 to 2024 or 2022, that's not long term. We were only thinking short term at the time, not long term. So you can see this happens, this happens, this happens. So it's okay that we are headed in an uptrend. We just have to make sure that we know that money's not cheap anymore. We need cash. We need to work on our income. For me personally, I sold everything or started working a side hustle just so I could make sure that I put my money where my mouth was, and I make sure that I had plenty of cash and no debt. I have a truck payment, and that is it. That's all. So, and I made a lot of sacrifices to do that because now I'm seeing what's going to happen, right? Because all these people that financed all that debt, besides their house that's on a 30-year fixed rate, well, guess what happens if we go into an environment like this? Their monthly payments on everything is going up, especially credit card debt and home equity lines of credit and anything of that nature, because they're not fixed and they adjust. And this is exactly what like your Dave Ramsey's of the world talk about, is being over leveraged and not having enough cash to cover if something goes bad. Okay, so things to note that I wrote down here is, in most of our lifetimes, money's been cheap. What do we need to focus on? That's very, very simple. Cash. Out of debt and get in cash. Okay, and get in the markets, because you have to try to beat inflation. Hopefully this uptrend does not last 40 years like this downtrend did, or it doesn't last 70 years like this uptrend did. However, it could, and we need to prepare for that, because remember what I said earlier in the video, range bound is the rule and a breakout is the exception. So a breakout to head back down will be the exception. Range bound is the rule. So we need to plan for the rule. Okay. We need to plan for higher interest rates, meaning 30-year fixed mortgage rates. Make sure you're getting that. Make sure you're really paying attention to your debt, credit card levels. And anybody that can't read this, unless they were in the business in 1961, 1971, 1984, unless they were in the business then, like actually in the business, don't listen to them, because they don't know what they're talking about. We have been in a downtrend since 1984, and most people weren't 30 years old at that time. That'd make them like, what, 90? So we're in a different environment, all right? And so the next part that I want to talk about is why I think currently there is no exception for us to break out of this trend. Okay, so remember me telling you about the 10-year treasury and what that is. So basically, when you buy the 10-year treasury, it's considered a safe investment. So it yields 4.5% return over a decade. Currently, inflation is over 4%. And at the end of the day, there's savings accounts right now in 2024. There's savings accounts at banks that are fully liquid that pay you 5% return. So would you rather buy the debt of a government with a chaotic political landscape like we have and out of control deficit spending? Because how the government gets money they don't have is they issue treasuries. Okay. So when they issue these 10-year treasuries, this is how they overfund the government, right? So eventually something's going to have to change. And I don't think until our government gets its spending under control that this is going to be a smart investment for investors. And so to kind of break that all down in layman's terms is, if you're going to buy government debt, just you yourself as a human being, if you're going to buy government debt, how much return are you going to have to get in order for you to say that it's worth it? 4.5% to 5% is probably not that number, right? Just because it doesn't even outpace inflation, and you can even get savings accounts that have no risk for that. So you're not going to buy the government's debt that you know doesn't manage their money well. You're just not going to do that. So when the 10-year goes up, that means that it pays out more yield. So for me, The 10-year would have to get to, probably 6.5% for me to consider investing in that. And inflation would have to come down. And then I would consider buying those treasuries. Now, the other thing that I kind of want to note here is you hear a lot of people in mortgage and real estate talk about inflation, right? Something I really been studying a lot of is like what is causing all this freaking inflation. Like I understand, I understand like what they did in 2020 when they spent all that money and gave a bunch of money away, gave a bunch of money to corporations. It devalued the currency, and that's what caused inflation. So your dollars are just worth less because there's more currency on the market. Well, what people fail to understand right now is they think the government thinks they're fighting inflation. Okay, the Federal Reserve thinks they're fighting inflation. However, because they're deficit spending, what are we, $38 trillion in debt as a country? Every time they print more money than we bring in, it's causing more inflation. So you can't fight inflation until the government spending gets back under control. So they can bring down prices and make the consumer hurt and make the economy hurt as much as they want to, but until they quit spending and devaluing the currency, then inflation can't be fixed. So I hope that makes sense. If you have questions or you want a breakdown of something else, put them in the comments below and make sure to hit that subscribe button for me. I'm going to do a breakdown like this constantly, like once a week or so, just to keep you in the loop, because I just feel there needs to be more of a facts over feelings type environment because people are freaking out right now and they just need to understand the data and the landscape. And the only thing I have left to say is that when it comes to the housing market, just because these rates are going up doesn't mean home prices are coming down either, because we are like 2 million homes short of inventory and it's not getting better anytime soon. So what I think is going to happen is I think that buying a home is going to be, it's going to be a luxury. It's going to be a luxury for the very few people that do have the money to do so. It's no longer going to be for the middle class because, let's be honest, our current government, current administration, and this is Republican and Democrat, they don't give a shit about the middle class. They've eliminated it for the most part. So home prices aren't coming down, but neither are interest rates. So if it makes sense for you to buy, buy. If it doesn't make sense for you, then rent. It's okay to rent. Because of where I am in my life, after divorce and after selling real estate, I'm renting an apartment because I'm in savings mode. And currently, it is significantly cheaper to rent than it is to buy right now. And so for a little while, until I get a certain amount saved up and get my savings back where I want it after my divorce, I'm going to keep renting for my $1,650 a month in rent instead of paying $3,000 a month for a mortgage. It just allows me to invest the difference and grow that difference, so I can grow my wealth a little bit faster. But I don't have a family or anything like that, so that makes more sense for me. There are some people that have a family that it doesn't make sense for them to rent a 1-bedroom apartment. They can't rent for cheap. So just make sure that whatever you do, block out all the noise and all the emotions. Let's look at the facts, because that is how wealth is created. It is not through emotional decisions and what you think is going to happen, because I am sorry. And I'm the same way. I can't just think and know what's going to happen without doing the research, right? I wouldn't have known this without looking at the data and taking my emotions out of play. So hope this helps. Like I said, hit that subscribe button. Leave any comments that you have in the comment section below, and hope you guys have a kick-ass day.